Nirmal Bang Equities, we welcome you all to the Q3 FY19 results conference call of IFB Industries Limited. The management is represented by Mr. Prabir Chatterjee, Director and CFO, Mr. Rajshankar Ray, CEO Home Appliance Division, and Mr. Arup Das, Head Marketing Engineering Division. I now hand over the call to the management for their opening remarks, post which we can take questions. Over to you, sir.
Thank you, Chirag. Good afternoon, everybody, and welcome you all to the conference call. I have with me my colleague, Mr. Rajshankar Ray, CEO of Appliance Division, and Mr. Arup Das, Head of Marketing Engineering Division. During the quarter, company has reported a total income of rupees 671.83 crores, with a growth of 25% over last year. EBITDA for the period was rupees 36.03 crores, with a margin of 5.6%. Despite growth margin was high, margin was lower because of the fact sudden increase in import duty of certain traded products, adverse exchange fluctuation, and commodity price increase. For the year ended December 18, the company has reported a total income of 1926.03 crores, a growth of 15%. EBITDA for the period was 115.90 crores, with a margin of 5.8%. The margin was, like I explained earlier, because of the import duty hike, exchange fluctuation was not up to our expectation. And with this, I will hand over the call to you for questioning.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset mode while asking your question. Anyone who would like to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question from the line of Srinath V from Bellwether Capital. Please go ahead.
Sir, could you please throw some color on the new initiatives taken in the AC space from a product standpoint, distribution, and also from a team standpoint?
I will request Mr. Ray to answer this question.
Yeah, Rajshankar here. There are 3 areas of initiatives which are currently on. The first is that if we look at the industry, there is a very high percentage of sales that goes through a channel which is called as the sales and service dealers. And this is a channel that both sells and services the ACs. It also has good reach into institutional sales. So what we have been doing over the last 2 to 3 months is creating a team that will specifically address this channel, which is the technical part of the sales channel, and the profile of the people is more technical than the normal sales team. So this is the first initiative. The second initiative is that we have begun a project for localization of the air conditioners, where we will be manufacturing as opposed to trading. This project has already begun and it is expected to conclude for a commercial introduction of the ACs in January 2020, which is the early part of next year. And the third initiative is with what we have in terms of expanding the volume of the range that we presently have for this season. Looking at the network additions that we did over the last 12 months, from which we need to get much more extraction, account by account in terms of where the ACs should be placed for us to increase the volume per se of this segment. That is also work that is going on for the last 1 month or so. So these are the 3 areas of initiatives.
So this sales and service channel would be like an MBO channel. Could you kind of shed some light on that? And the second follow-up would be on the localization. What percentage of our product would get localized post 2020?
So the first part of the first question, which is whether this channel is a multi-brand channel or not. Yes, many of the sales and service dealers do deal in more than one brand. But typically, the better part of the channel would be dealing with maybe 2 to 3 brands at any given point of time, as opposed to a typical retail multi-brand store where you would walk in and you would probably find 15, 20 brands. So they work.
Where's the shop? As in, is it a shop or is it the service center person coming in, recommending?
It's like a small. These are typically small places with people who've been established in the network for a very long time. They normally don't have displays, but they have the network to sell based on their service ability.
Okay.
You could walk in and maybe see a small display, but by and large, these are very small offices inside residential areas, close to institutional areas, etc. It's not the typical store that you see.
Okay. And localization post 2020?
As far as the localization is concerned, we are planning for a significant portion of the work to be done in-house by us. So, for example, manufacturing of the heat exchangers, etc., which typically people buy out, we'll be manufacturing it in-house. The electronics will be from within India, day number one. Compressors, which are typically imported currently, there are 2 factories which are coming up. So I would expect that a significantly high portion, maybe 50-odd%, would be sourced from within India immediately in the beginning. And over a period of 2 to 3 years, I think the entire Indian requirement, maybe 85-90%, will be addressed by the manufacturing facilities that are coming up within India.
Okay. Just wanted to get one more question. Could you please share the volume share of the 6.2-liter washing machine and the twin tub manual washing machine in the top load market for the entire industry?
So if you look at the total industry for top loads, including let us say semi-automatics, then our estimate is that it is about 1.6 to 1.7 million as on date.
Okay.
Out of that, the fully automatic segment would be roughly about, the fully automatic segment itself is about 1.8 million.
Okay.
And the semi-automatic segment would be probably about 2.5 million as on date.
Okay. And we are only getting a product in the 6.2 would be the fully automatic. Are we looking at a product in the semi-automatic space also, sir?
No, we are not looking at the semi-automatic space at all. The 6.2 or the 6 kg segment, where we have not been present as far as top loaders go, accounts for about 50 to 60% of the industry as on date, of the fully automatic industry.
So that will be 50-60% of the 1.8 million.
Yes, correct. So that segment we have been missing, and with the introduction of a model in that price point, logically we should be getting volumes from that segment as well.
Okay. Thank you.
Thank you. The next question is from the line of Manoj Gori from Equirus Securities. Please go ahead.
Yeah, good afternoon. So I just wanted to ask, in the opening remarks, you highlighted more of traded products actually dented the gross margins and had a severe impact. So what kind of traded products were this? Because as per our understanding, if you look at it, it's only for refrigerators, washing machines, and ACs and on compressors. So what was the traded components that we did?
Yeah, so Rajshankar here, mainly 2 products which have got affected. One is the microwave and the other is the air conditioner. And the effect was a sort of a combined effect. One was the increase in the customs duty by 10%, and the second was the increase in the forex level. So microwaves were extremely profitable for us, and there was a profit erosion that we had as a result of these two, and a similar effect on the air conditioners.
Right. So
these are the two major areas of it.
Okay. So going forward, what would be the approach of IFB to tackle such pressure?
So there are the answer to this is in two parts. As far as microwaves are concerned, one is that there have been some commercial negotiations with the supplier, and we have got some reductions from them. The second has been that we are passing on a price increase, which will become effective from February. And the third is that we have reconfigured the models and the model mixes. So the combined effect of these three will address the issues that we've had on microwaves to a large extent. As far as the air conditioner segment is concerned, there is a price increase that we have already passed through, which will become effective from around the end of February. However, as far as ACs go, that will not completely address the combined effect of the customs duty as well as the increased forex level. So that part of air conditioner which we will not be able to recover, we will have to make up through increased sales of the other product categories. And this will get fixed once our own production kicks in from January. So till that time, ACs will be partially addressed.
Right. So in this case, if you look at from a next couple of quarters perspective, the gross margins are likely to remain under pressure, despite taking the price hike, because obviously AC sales would be higher. And do you see any impact now as the raw material prices have also eased off? So do you see any positive impact coming from for your washing machine category?
So we are expecting some softening of the raw material pricing. And if that comes, let's say, from April onwards, then that will obviously be positive to the margins. We are expecting something, but we have to wait for another month or two for it to really be realizable.
So at least for this fourth quarter and also for the first quarter of next year, so there could be some pressure on gross margin. Is this understanding?
If you look at the gross margins per se, you will find that our gross margins actually have been quite stable. In fact, on the manufacturing side, we gained the gross margin both in the previous quarters. But the gain of that gross margin from manufacturing got eroded by the impact on shipping. So once we fix the microwave issue and some of the more the material cost side work that we're doing on the manufacturing side kicks in, I would expect that the margin structure of quarter one would be definitely better.
Okay, so that's all, sir. We'll get back in the queue for further questions.
Yeah.
Thanks a lot and wish you all the best.
Thank you. The line from Sarup Basis got disconnected. Just give me a minute while I call him back before we take the next question. Ladies and gentlemen, thank you for patiently waiting. We have Mr. Das reconnected to the call now. Thank you. We'll move to the next question, which is from the line of Abhishek Ghosh from DSP Mutual Fund. Please go ahead.
Thanks for the opportunity, sir. So just a couple of questions. This localization of AC project, what will be the overall capex towards that?
Yeah, Mr. Chatterjee, would you like to answer that? Yeah, the overall capex to start with will be 124 crores for the first year. Over a period of 3 years, we'll be spending around 200 crores.
So by FY20 you will be spending something like 200 crores in that, is it?
23, I would say.
Over 23. Okay.
Yeah.
Okay. And so currently our AC revenue run rate will be closer to 200 odd crores. With this capital expenditure or with this capital employed of 200 odd crores, what kind of revenue can one, do from that?
So this is Rajshankar here. I'll answer that. This capex, which is planned in a phased manner linked to volume growth, this capex will be good enough to give us 600,000 ACs. So that would be a revenue of roughly about 1,800 to 2,000 crores.
Okay. But from FY20 onwards, large part of it will be through our own manufacturing only, right? Or FY20 second half? Or sorry, FY21, my bad.
From January 2020, we are planning 100% localization as a result of this project. I mean, everything will be from the plant in India.
Got it. And so just one more thing. Is there I see receivables quarter on quarter reducing by almost about, closer to about 100 odd crores. So what would that be attributable to?
By you mean market receivables?
Yeah, from your debtors.
So our data cycles are actually quite good, in fact, and so whatever reduction you are seeing is because
this is almost 100 crore reduction in that I see in debtors, but correspondingly in the capital employed segment, I am not able to see that both for home appliance and engineering division. So
because the debtors, what happens is that the seasonal this thing is there, so you get back the money. That during the season it goes up, but after the season you get back the money. And then you are saying you cannot see the effect because partly inventory has gone up because we are stocking up inventory of AC for the season.
Okay. And so just one last thing, quarter on quarter we see gross margins to have come.
Yeah, I would explain this. Like for example, one part is what Mr. Ray has already stated, that because of the sudden imposition of the import custom duty on few of the traded items, like where we are affected was the AC and microwave and the forex. But there is another part is there which is around 3%. That is because you remember last time there was a question that other expenses went up. Because post GST there was a change in how we were replacing the warranty and AC spares. So which was earlier grouped in the other expenses, now it is the second quarter was regrouped again into the material. That is why you will see now other expenses are falling in line.
Correct.
Without that the correction for that regrouping effect is 3%. So you are seeing a gross margin difference of 5%. Out of that 3% is because of that which will not be there anymore.
So now it is sitting as part of bill of materials there.
Yes, it is part of material because prior to GST coming in, what we used to do for replacement of warranty and AMC, we used to give replacement of spares. But under GST, whether you give anything or take anything, it has to be through sales and purchase. So in EBITDA margin, it is absolutely neutral, but to that extent, sale and purchase will go up.
Got it.
And it will have an offsetting effect.
Okay. But sir, even sequential basis, I understand this is helpful, but our margins have kind of come off on a sequential basis. And what we were earlier doing trajectory of that 7% kind of a margin on an annual basis, that has kind of come off in 9 months. So how are we looking, how is the margin profile now looking maybe for next...
See, I will tell you, for example, we normally do not give any guidance, but like already explained by Mr. Ray, that suddenly because of this duty, we were affected, our margins were affected, both in terms of microwave and AC, where we are doing pretty good actually. But because of the duty, forex and other things, the total margin has come down, number one. And in case of imported material, suppose you clear after paying the custom duty, you are not in a position to increase the material, increase the MRP afterwards. Okay. So, for example, that is why 2-3 steps, like he said, one is we are negotiating with the suppliers to bring down the price, purchase price from them. Second is increasing the price from February. And third is, improving the mix. By these steps, to a large extent, we'll be able to recover the margin in the micro oven. But in case of AC, we may not be able to do that. But like Mr. Ray said, we'll try to recover it by increase in volume in other areas.
Okay. So just one last question. What will be the capex for FY19 and 20?
FY19-20 would be, but we have not finalized yet, because once we do the budget, we do that. That would be in February, March. But in addition to that, like Mr. Ray has already explained, that AC projects around 124-25 crores would be there.
Correct.
And the other part, routine and other areas and engineering, we are working on it. Once our budget is over, we'll be in a position to tell you.
Okay, no problem. Okay, sir. Thank you so much for answering my questions and all the best.
Thank you. The next question is from the line of Mitul Mehta from Lucky Investment Managers. Please go ahead.
Yeah, hi, good evening, sir. Mr.
Good
Raj,
evening.
Mr. Chatterjee. Yeah, Mr. Shekhar, Mr. Rajshekhar, just wanted to get some understanding on, on the volatility in margins that we seem to be witnessing since last 4 quarters, and going forward, how well we can, get our business up to a decent, sustainable margin. So my first question to you is on the material cost. So are we as a company embarking on some sort of a material cost thing? When you did mention about negotiation, what else are we doing on the material side so that we can be far more profitable? And secondly, also as far as other expenditure goes as a percentage of sales, there do you think we can see far more leverage as we increase the volumes and as we put our 6.2 kg in the market? If you could just elaborate on these two.
Okay. So I will just answer it in 3 parts. One is, if you look at the material cost related area, then currently we are addressing it in 2 ways. One is, if you look at the manufacturing material cost, one part of the exercise which we completed in the previous quarters was localizing areas like electronics, etc., completely into India. So if you look at the margin structure of the new models which we started rolling out from Q3 and which will be completed by early Q1 of the next financial year, the margin structure of the new range is much better than the previous range. So that is because of the material cost work already done. In addition, on the manufacturing side, we are currently running some projects for reduction of material cost. These are by way of alternate materials in, for example, areas like plastics, where the basic raw material commodity usage related costs will go down on the manufacturing side. So part one of the material cost area is actually to get more out of the manufacturing material cost. For us, that is in the area of front loads and top loads. This is the first part. The second part is the material cost related to the imports, and in imports 2 main categories, which is microwaves and air conditioners. Now, the material cost in the third quarter was affected by the duties and the forex level. So in microwaves, we've already just shared what we are doing on the material cost side is essentially we have completed price reduction discussion with the supplier. We have passed through the price increase, and we have redone the model mix. On the import material cost on air conditioners, like we just said a few minutes earlier, we will be able to partially cover it up through a price increase, but we will not be able to entirely compensate the impact of the custom duty. We will have to compensate this with the other projects on the manufacturing side. This was the first point on the material cost area. As far as the area around the volumes are concerned, there are two things. One is if you look at the network increase that we made over the last 1.5 years, where we went from a network size of roughly about 4,500 to around 11,500 today. Our extraction from the network that we've added has actually just not been good enough. There is far more value that we can realize from the network that we have put in place. So one job that we have, and we have been, reconfiguring sales manpower, redeploying the structures, which is a job that we sort of completed in December 18, is to realign sales manpower to get much more from the new network that has been added. This is for all the categories of products we have today. Specific to the question that you asked on the 6.2 kg top loader, that was 50-60% of the industry that we were totally missing. The addition of models in that range will get us sales immediately because the same network is going to carry it.
Sir,
so that is the third part. Have I answered all your questions?
Yes, you have answered. Now, sir, so is it fair to assume that as far as the material cost goes and what you have enumerated in terms of all the exercises ongoing and some of it being completed, is it fair to assume that from here on Q4 and Q1 into next year, we should see increase in gross margins? Because your washing machines are, the value engineering seems to be more or less completed. Your microwave is also more or less completed, and we've increased prices there to counter any cost pressure. So the last one is the AC one, which again is not a very significant contributor as of now. So is it fair to assume that our gross margins should actually look up?
Yes, so that is definitely something that we are committed to, because this is one area that, we have really not been able to lock down completely, and for our own this thing also we need a better margin profile. So for us today, this is priority one basically in terms of what we need to deliver.
So Mr. Rajshekar, in terms of EBITDA margins, what is the number that, over let's say next 2-3 years, I mean, what sort of number that you would be comfortable with? Because, currently, we are not making as much money as we should be making it. So, let's say over next 3 years, what sort of EBITDA margin you would be comfortable with?
The point that Mr. Chatterjee and I have always made in the investor call is that a double-digit EBITDA profile is something that we are committed to, and we just have to deliver it, actually. So when you have a quarter like that, like we've had in Q3, you are far off from that double-digit commitment, but that is something that we have to deliver. And the projects that we are doing are targeted at that.
Have we appointed any external agency for material cost sourcing, or we are doing it by ourselves?
We are doing it by ourselves. So we have a fair degree of experience in this area, and our capability on the R&D side and the depth of manufacturing that we have, we are doing it ourselves.
So, sir, in terms of material cost reduction as a percentage of sales, in terms of, percentages, can you just throw some light? Let's say over next 2 years, are we, looking at 200 basis point reduction or 300 basis point reduction just out of material cost?
So, if you look at the manufacturing side of the material cost, a 2 to 3% reduction over the next few quarters is what the projects will deliver. If you look at the import side of the business, the material cost improvement will be much more, because once the ACs are being produced by us, the material cost structure will be completely different. So, as far as microwaves are concerned,
right.
Currently the actions we've taken is to just restore it back to the original level, basically.
So let's say if our material cost is 100 currently, what is manufacturing and what is imported? Just a ballpark number.
Mr. Chadwi, I think you can answer.
Actually, basically, if you see around 75 to 80% is now 70-75% is the manufacturing. The rest is imported.
So 25% would be imported.
23 to 20%.
25. Okay. Thank you, sir. All the best.
Thank you. The next question is from the line of Anshuman Dev from ICICI Securities. Please go ahead.
Yeah, thanks for the opportunity. I do understand the company is taking a lot of measures to improve the margin. And one of the things I additionally observe is that all companies in this space has lost gross margins YOY, be it because of RM pressures or high input duties or currency effect. But how easy has it been to pass on this kind of cost escalations in terms vis-a-vis your experience in the past? So because there are a significant number of new players who have come in. So is the competitive intensity difficult now to pass on the fare hike? B, if demand situation is, how is the demand situation as an enabler to pass on the price hike? Has it been better or worse in the past?
Okay, so Rajshankar here. If you look at the answer to your question as far as washers is concerned, which is front loads, top loads, we have really experienced no difficulty in pricing and in passing on any commodity price increases, impacts, or even impacts of forex. So that is no issue at all. As far as microwaves are concerned, this year in the first 2 odd quarters, we had difficulty in passing on price increase. That was primarily because one player, Samsung, took a very aggressive position and we couldn't pass through the entire price increase. As on date, we don't see any problem in the price increase that we want being done, which we have just shared in the call. As far as air conditioning is concerned, yes, we have an issue. We are not in a position to pass on the entire price increase. So my answer would be in manufactured products, no problems. In imports, air conditioners, as on date, yes, a problem. As far as the demand situation is concerned, we don't see any problem on the demand side at all. In fact, with the network addition that we have, we should be selling much more than what we are selling today, and that is a basic sales job that we need to complete.
Right. So, and the second question was, we are present in the premium segment of the washers, right? In the sense that our products command a premium in the market. So, just from a strategy perspective, there are players who are not premium and maybe playing the mass market strategy, and they report a better margin also. So, I'm just trying to understand that a mass and high volume versus a premium and a lower share of the market. Which strategy do you think is currently, as of now, is that a reason because of our margins being lower?
So, this point that you made is an interesting point, and the only benchmark that we can draw from a player whose results are publicly available is Whirlpool. Right. And if you look at Whirlpool, as far as the washers are concerned, their presence is both in top loads as well as on the semi-automatic side. Our understanding is that their margin profile is because of two reasons. One is because the refrigerators are dominant and there is a great deal of gross contribution that they're drawing from the refrigerator segment. We cannot benchmark that because we are not present. And the other is that their sales productivity is better than ours. So, like I shared a little while back, in terms of the network that we carry, we should be extracting much more from the network that was added over a year and a half back till now, for us to be able to get the kind of sales productivity that the Whirlpool has.
Right.
Have I been able to answer your question? My point to you is I don't specifically see this as a mass market versus a premium kind of a discussion for a margin profile. For us, the benchmark is that we need to get more sales, and whereas they come, for example, they cover the entire spectrum of the top load market, fully automatic. We've been missing, 50-60% of the market, and we just need to put a product into that and get the revenues that should come to us.
Right. I understand your point. Just that I am little bit of, because our product is priced higher, and because our front load is significantly high-end product compared to the other products, our margin profile being almost significantly different. But you have answered it because of your better productivity and all. So I'll take it. Thank you.
So that is one. And sorry, I'll just add one more point. The basic penetration of the washer itself in the Indian industry is so low today that, to really analyze a base and say that the front load is more expensive or the top loader or the semi-automatic is more mass market, currently I think it is very early stages because the category itself is very less penetrated compared to any index from anywhere around the world. So as the basic power conditions improve and the disposal income is in any case rising, the mere increase in penetration of the washing machine segment itself will give a lot of industry volume.
Sure. Thank you.
Thank you. The next question is from the line of Kashyap Javeri from Emkay Global. Please go ahead.
Yes, thank you very much for the opportunity. I had a question on, your other cost, employee and other operating expenditure. After, many quarters, they have stabilized at least for the last 2 quarters in terms of absolute number. What's your outlook on, these 2 cost line items as we go forward?
The other expenses is, if you see 75% is variable out of that, like freight, franchisee expense and other things, which varies with the volume. So other than that, 25% is fixed in nature, which increases with like rent and other things as per the agreement. Besides that, since we are adding IFB points, some rent increase would be there. Otherwise, expenses are under control. But in case of manning, for example, when we ramp up operations, additional manning, if it comes, that cost will come. And the normal increment that happens yearly, that it will come. Otherwise, our expenditure-wise, we are absolutely under control.
And on the rent side, we sort of spend almost about a percentage point of top line there. So are the, the rental agreements, are they sort of fixed in nature for a couple of years and then they increase?
Yeah, that is there. But the one recent increase that you are seeing, for example, we have got around now 170 IFB points, okay?
Right.
Where we pay the rent, but we recover by selling products.
Right.
So that rent, when we increase, it goes up. But all other rents are absolutely, the agreement is always for 3 months, 3 years with 5%, 7% increase. So these agreements are done like that only.
And how many stores are we, IFB points are we going to increase? How many have we added in 19 and how many are we going to add in 20?
Rashakar.
Hello?
Yes, sir. Could you just repeat that, please?
I'm saying, how many IFB touch points or IFB stores did we add in 19 and how many will we add in 20?
Yeah, so we are as on date at 490.
Okay.
We have 41 in construction as on date.
Okay.
So that takes us to about 530.
Okay.
And the typical run rate that we have would be maybe 5 to 10 on a per month kind of a basis, basically.
So does this then imply that the fixed cost part also will to some extent grow at about 10-12%, including the new stores?
No, actually, the bulk of the additions now that are happening, or in fact almost 95% plus of the additions that are now happening are franchisee-run stores.
Okay.
Which are essentially investments by the franchisees.
Okay.
The company-owned stores that we did were primarily in the metro areas because there the essential rentals are very high and there is a marketing leverage also that we get by presenting all the products of the brand. But other than the main metro cities, everything else is a franchisee on the network.
So then at least should we assume that on the employee cost part, plus this 25% of the other OPEX, the operating leverage should start playing from FY20 onwards?
Yes. We don't see any significant increases on this.
So just to clarify on the employee cost plus 25% of the other OPEX. That should, start at least, playing out operating leverage as we go forward, but 75% of the OPEX is still variable.
Yes.
Okay, sir. So, thank you very much, sir.
Thank you. The next question is from the line of Ankit Kedia from Phillip Capital. Please go ahead.
So just wanted to know what is the rationale of doing own manufacturing of AC. Currently we have less than 1 lakh units of sales. Our brand in the ACs is not very strong and it's the most competitive category. Along with that, we have other manufacturers like Ember and all who do manufacturing for others at a reasonable cost. So what is our roadmap for next 3 years? You said 200 crores would be the expense and a 6 lakh capacity. So how do we envisage 6 lakh sales in 3 years, or we'll do contract manufacturing for others as well?
So that's a good question. I will try and answer this. One of the problems I think that we have had in air conditioners is that as long as you import and sell, you really are not taken fully seriously in the market. And if you reflect back on the experience that we had on the top loaders, where for many years we used to essentially trade the top loader as a category, and we were having volumes of 50,000-60,000 in a year. As soon as we moved into manufacturing, we could configure the product the way we wanted. So it looked different, it was different, and we had a clear-cut position as far as IFB is concerned. The market immediately responded. The reason we are investing into the air conditioner manufacturing is for 2-3 reasons. One is that it is simply not viable to import and sell air conditioners given the current level of the customs duty and the forex level. The second is that it is a market that will grow because the penetration is still very low. So we think that for a product configured in line with the IFB brand and produced by us the way we produce the washers, etc., we think that that will actually have a positive impact as far as sales is concerned. The point about whether we would like to do OEM, etc., yes, there are 1 or 2 people who are interested, but I think that is very, very nebulous now. That will take care of itself, I think, once the factory is built. Primarily, the capacity that we are creating, it's not 600,000 immediately, it's in a phased manner. The first phase of investment, which is about 125 CR that we are doing, will give us a capacity of 350,000. And looking at the size of the market and the network that we have in place, given a good product at the right price, I think we can get those volumes.
So then why can't we get it done by Ember, who does contract manufacturing for other brands as well in India? In the sense, such a big capex outgo with less than 1 lakh, 1 lakh units currently we are selling. I can understand once you have reached 3 lakhs, you have the ambition to do own manufacturing because it's a big category. But why at this point of time?
So the answer to that will be that we have studied the option of buying out from contract manufacturers within India. The quality level and the product configuration that we want to present cannot be done through this route. So we have done an in-depth study on this, and which is why we chose manufacturing after this study.
Yes, sir.
I say one thing.
Yes, sir.
Mr. Ray just mentioned the year before we started manufacturing, our top loader sale was 39,000. Next year was 118,000. Year after that was 176. Then 225. So when we start manufacturing, you have many advantages. We are very sure that you can go up to a different level.
So just a point, sir, you were known for washing machines and our front loader was very strong. So, with front loaders, top loaders is a logical extension. And competition in the fully automatic category was not that high. Compare that to ACs, which is a very, very competitive market. And customization is not very different in all the ACs. Hence, the question.
Yes, so Ankit, it's a good question actually. and is definitely valid as a point that needs to be considered. Our belief was that the market size is big enough for us to really do a good manufacturing project with a great product at the end of it, and hence find a clear space for what would be an IFB AC. As long as we trade or we buy out, what we really want to present as a product under the IFB brand, we are unable to do that fully.
Sure. And so with that product, will we be able to give the 30-35% trade margins, because we are not present in all the counters today as well, because the trade margins demanded are very high. Suppose that, will we be present across the board where our washing machines is currently?
So actually, if you look at, what the good players in air conditioners are doing currently, this issue around the 35% margin is actually only limited to a few accounts. So they balance the scheme cost. You would be running networks where the scheme cost is not so high, and there would be some retail partners where perhaps you would need that sort of a scheme to, get the placement that you need. So if you have the right product range which can address both these type of channels, then you can do exactly what the established good players are doing within India, which we are confident we'll also be able to do.
Sure. All the best, sir. Thank you.
Thank you. The next question is from the line of Utkarsh Somaiya from Anand Rathi. Please go ahead.
Good afternoon, Mr. Chatterjee. Thank you for the opportunity. So I had a question on your capacity expansions that you undertook for front loaders and top loaders. Correct me if I'm wrong, you began that in Q4 of FY18, right?
Yes.
Yes, sir. So could you please tell me where is it placed as of now, as in when is it expected to get over, the entire expansion plan?
So there is the last phase of the expansion which will be completed by 31st March of this year, and that will give us a capacity of 600,000 for front loaders per annum and 450,000 per annum for top loaders.
Okay, so as of now, capacity stands at what it was prior to that, correct?
As of now, the capacity, if we stretch, can go to roughly similar levels in front loaders and maybe around 300,000 in top loaders. So there's a little bit of the balancing of the operations in-house, which will be completed by 31st March. Our next year capacity plan is there. Okay. What I just gave you.
Okay. And so also, when do you, in the first year of your operation after expansion, do you, what kind of capacity utilization levels do you expect?
So we have been enjoying high capacity utilizations, 85% plus over the last 2 years or so.
So right.
This is around about the kind of volumes that we target for next year as well.
Okay. So you mentioned that your capacity stands at 300,000 for top loaders and it will increase to 450,000. So do you expect the capacity of 450,000 to immediately go to 100% in your first year? Or do you think...
So if the response that we are expecting for the 6.2 kg price point comes, then if you look at the size of the market, then these sort of volumes are definitely possible.
Okay, sir. And for front loaders?
We have to wait and see, because we will introduce the 6.2 kg early Q1.
Sure.
Sorry, you were asking something on front loader.
Yeah, so I was going to ask the same question for front loaders, like would you expect to reach full utilization in year 1? If not, then what are the number you expect?
Full utilization would be year 2. Year 1 utilization would be 85% plus.
Okay. Thanks a lot, sir. That's very helpful. And also, can you please share the volume numbers for front loaders and top loaders?
I will request you to talk to me separately, please.
Sure. So I would also like numbers for the subsidiaries. So should I ask you that separately as well?
You give me a call separately, I'll answer you.
Okay. Thank you, sir. So, and out of the IFB points, you said 490. How many are currently franchisee models out of the 490?
165, sir, our company owned. Balance is the franchisee owned.
Sorry, sir, I didn't quite get that. Can you please?
165 numbers are our COCO stores, company operated,
Okay.
registered franchisee owned.
Okay, sir. Okay. So, and one last question, please. On our front loader exports to Panasonic and other OEMs, so can you please tell me the volume number you did for 9 months FY19?
So this year we have not done any exports to Panasonic because they opened up production in their own factory in China and they are buying from there. So we have not exported anything to Panasonic this year.
Okay. And any other OEMs?
So as of now, none basically.
Okay, sir. Okay.
Other than in Nepal.
Sorry?
Some export we make to Nepal. Not much.
Which is under the IFB brand. In OEM capacity, nothing.
Okay. So on the export front, we shouldn't really expect much going forward, right? As of now?
No, I don't think there's anything much here.
Okay. Okay. So I also had a question on the Ramson's acquisition. So just wanted to confirm now our capacity strength has increased to 400 kgs, right? From 160 kgs earlier?
Yes, correct. We can build up to 350, 400 kgs as well, yes.
Okay. So you think you can give us an idea about how big this market is as compared to what it was before we acquired, like the difference between 400 kgs and 160 kgs market size?
So this is actually a market, waiting to be created because as far as the industrial laundry is concerned, the equipment replaces manual washing. If I can just give you an example, in last 2 months, in Chhattisgarh, one or two of the jails actually went from washing clothes manually to actually investing in laundry equipment, where the inmates are now washing for the rest of the inmates, including all the hospital, all the jail linen, etc. And so it has opened up a big market for us. But it is replacing manual washing. So if you just look at the vertical of jails across India, that itself is a huge market. The key challenge here will be that we will need to go to all these buyers. We will need to sell the concept. We will need to help for the concept to be converted into a business case for their internal sanctions. And then our sales will come.
Got it. So basically, you cannot put a number to it because your potential customers can be like variable. You wouldn't expect a jail which it turned out to be. So similarly, there can be other institutions which can be potential.
Yeah, we all know that the colleges are very, very good markets for laundrettes to open up because the students are outsourcing clothes and everyone's wearing branded clothes. So the growth of this business for us is going to be marketing led. We have to be able to go and convince customers about the business case and get the sales done. And now that we have two teams, which is the earlier IFB team and the earlier Ramson's team fused into one, so the numbers are much more now, and therefore our ability to reach customers has significantly increased.
Okay. Very helpful, sir. And on your modular kitchens, you mentioned you had a good order book this quarter. Could you please throw some light on that?
So currently we are working in 3 locations, which is Goa, Bangalore and Kolkata. And the order book that we have now is almost 5 to 6 months of sales. But the sales itself is at a very low level because it's only 3 showrooms.
Right.
So the agenda for the next year will be to pick 5-6 more locations and expand this business.
Okay.
And the other pilot that we are doing now in Goa is a combination of an IFB point and also a kitchen. So some locations where we currently have IFB points could also become locations where the showroom could showcase kitchens as well as the appliances.
Okay.
But that is currently in only a pilot stage. We will take a few months to really pilot this and understand whether customers respond or don't respond.
Sure. Could you give us a number of the order book, if possible? I understand it's low. Just would like to know how we should look at it going forward.
In terms of value?
Right.
Yeah, in terms of value, it will be, let's say, roughly about 4 to 5 crores.
So roughly about?
4 to 5 crores.
Okay. And we should expect this number over the next year, any substantial increase?
No, this will increase. So currently, if you see, if we do roughly about, let's say, 60 to 70 lakhs basically a month on the kitchen, this should rise to 2.5 CCR per month, basically, based on the pipelines that are building up. It's still small.
Got it. Understood, sir. Thank you so much, sir. That was very helpful.
Thank you. The next question is from the line of Vaibhav Kacholia from VK Capital. Please go ahead.
Sir, can you give us some color on the market demand and environment in the present and the immediate next 1 or 2 quarters?
You mean market demand across all appliances?
Yeah, and especially washing machines.
I think it's still healthy. November specifically September, October, November, all 3 months were very good. December was a little stressed, but as on date, we see a very normal market demand for this.
So there is some news reports and all that January, February is very dull and stuff like that?
No, not
for us,
maybe,
for the industry overall.
See, I don't think so. I mean, it was a little tight as far as air conditioners are concerned, and people were sort of dumping material here and there. But otherwise, I think it is okay.
Okay. So we don't see any slowdown in the market as well.
It was quite satisfactory.
Okay, fantastic, sir. Yeah, go ahead.
We don't see any slowdown. Yeah, no, we don't see any slowdown, I think.
Okay, fantastic. And sir, one question I had, are we subsidizing these IFB points and are our margins a little lower because of the costs we are incurring in the IFB points currently?
Not at all, because the RFB point total number of sales is around 15% of total sales, number one. Number two, it does a branding for us where we showcase all our products. And with the COCO stores coming in, we are making profit from that store. We are not losing any money.
From the franchisee?
We are breaking even. We are making money from them. So there is no question of margin coming down from them.
From the franchise stores, right, sir?
So I'm saying COCO stores. Franchisee stores, they are selling actually. So whatever we sell through COCO stores is our gain. And definitely franchisees are making profit. That is why they are running those stores.
But we don't need to subsidize them initially or for some marketing activations.
No, maybe initially when they start for 1-2 months, we give them some support to start with. Then they go off their own.
Okay. And sir, these what you are saying in the urban cities or wherever you are using it as a branding tool, so that whatever that branding benefit, that is a hit on the margins in a sense?
No, it's only
they are, like I said, COCO stores. We are not losing money overall. We are making money.
But the margins would be coming down because of that?
No, margin will not come down. But if you are having your own store, there will be some rentals against that.
See, I'll just clarify, Rajshankar here. I'll just supplement to what Mr. Chatterjee said. You know, when you're running a franchisee store or any retail store, there is a typical channel margin that you have. So that could be 22-23%, right?
Right.
When you get into a COCO store, actually you are not paying any channel margin, and that is what is actually driving the rent. So if you look at a company-operated store or a franchisee-operated store, in terms of the actual margin structure, it will be similar. In the case of company store, the only difference is that the channel margin has come to the company, against which we are actually paying a rental for some of these locations which are high rental areas.
Okay. So our costs within the COCO stores are within that 22%?
Yes, largely, and it is as profitable as any other channel.
Okay, right. Thank you so much, sir.
Thank you. The next question from the line of Aditya Agarwal, an individual investor. Please go ahead.
Hello. Thank you for taking my question. My question is, given the large market share you have in microwave ovens, wouldn't it be a better use of capital to start manufacturing microwave ovens instead of ACs, in line with the previous participant's question?
Yes, so it's a good question. We have considered this, but the manufacturing base within China for microwaves is so large that it is next to impossible to be competitive with the manufacturing ecosystem within India. So if you look at the typical components like the small transformers, small motors, just the cost of the door glass in a microwave, the volume benefits are so large out of China that in India we will not be able to match the material cost. So currently it is not viable.
Correct. That makes sense. In terms of the comment you made on that it's been a difficult task to extract value out of your network, why do you think that has been the case despite the strong brand positioning of IFB, especially in the washing machine category?
Yeah, so I will answer this question. See, the addition that we have made in the last 18 odd months has been a network that has been created through distribution. And typically IFB earlier, our 90% of the network used to be retail outlets that we were servicing directly. And even today, the bulk of the sale continues to come from that network. Now, the distribution network that we opened up needed a skill set at our end to understand how to handle a distribution network. And because these are very small outlets, each of them needs to be trained to sell an IFB product. So, they need to understand how to present the IFB front loader or the top loaders that sit at the higher end of the price range. So, it is taking us time to actually train each of these outlets, get the movement of our salespeople to also cover the newly opened outlets vis-a-vis the existing outlets. So it is just a question of time, and this whole network is, about a year and a half old. We think that we could have moved faster, but I think once we've completed our sales realignment, the training of all these networks, the value extraction from this possibility is very large. We just need to do a much better sales job, per se, in getting value out of these outlets.
I'm not sure I understand fully. You say they are small outlets, but there is large potential for sales in the future. What percentage of the overall industry sales would possibly come from these outlets?
If you look at players like Whirlpool, LG, Samsung, etc., they operate more than 70-75% of their sales through this distribution network. So if you look at pure numbers, we used to earlier have 4,500 directly serviced accounts, and we have added around 8,500 through the distribution network. So even though individually they may be small, but put together, their contribution to business can be quite large for IFB. Have I been able to answer your question?
I would like to just follow up on that. That addresses my question. Is it essentially, my understanding was that numeric distribution is quite irrelevant in this industry. Weighted average distribution is more important. The long tail, while quantity-wise, from what you are saying, sounds 4,500 directly versus 8,500 indirectly. Would this contribute to possibly 20 to 30% sales in coming years should this network behave the way you expect it to?
Yeah, so this weighted average distribution that you use as a term is the correct one. If you look at earlier, our network was probably having a weighted distribution of maybe 65 odd %. And with the addition of this network, we are now at 85% plus. So in terms of weight to us, this would be about 20-22% addition over the last year and a half.
Right. And following up on that, what percentage of your network would stock more than one of your product categories?
A very high percentage. I don't have an exact number on it right now for you, but wherever we are doing business, it would be for front loads, top loads, microwaves. So typically a retail outlet would buy at least these three products. The percentage of accounts where we also have ACs placed today is low, but for front loads, top loads and microwaves, these are generally present in most accounts. And a section of accounts also has the dishwashers the kitchen appliances, those product categories that we have.
So just a follow-up to that question, if they're already keeping, what is the training? Is it the share of sales at that outlet is low primarily right now, and that will take time to ramp up as the salespeople manning those outlets get more comfortable with explaining the features of your product? Would that help drive sales? What would drive sales to the outlets that you're already present in?
You are right, because in the newly added network, our share of sales is very low. And those outlets themselves are selling. We need to actually get share from those outlets. So as our people settle in and they understand how to sell the IFB products better, our share of business in those accounts will increase. You are right.
For example, would you have any rough estimate, very rough, nothing exact, like in the top 20% of the outlets that you service directly, your share of business would be, say, 30%, whereas in the bottom 10% of the outlets that you added, say, 20%, your share of sales is like 10%. Any broad...
So we don't look at it, in terms of an overall share, because if you look at a front load, for example, we would be running at 40%. But if you look at an air conditioner, we would probably be running at 1 or 2%. So what we look at in the counter is how do we increase the share of each category, not the overall basket.
So precisely my question, maybe I phrased it wrongly. For example, in front load, you have 40% share in the overall market. In these 20% of the outlets, what would be your share of front load, for example? Or is it that you are over-indexed on the places that you're already present? Your 50% share in the outlets you're present, but 40% overall. I'm trying to understand what's your share, what's the scope for volume growth in these new outlets or bottom half of the outlets that you've added?
Yeah, so, let me see how I can answer this. If you look at let's say the recently added network, and you go category by category, then in that, our AC share would probably be less than 1% because the air conditioners still need to be placed across that entire network. If you look at top loads, for example, if we have overall 8 or 9% share, in those set of counters, we would probably be operating now at about 3 or 4% because our sales are still not stabilized in those outlets. If you look at front loads, then probably once we are placed, our share would be more or less in line with our overall share in any case because the front loads are well established. As soon as we are displayed, customers will buy. So, my response to your question will be that it depends on the category. Overall, our extraction from the newly added network is significantly lesser than the extraction from the network that we have traditionally been displayed in. Which is why we feel that if we extract more, then logically there is a lot of volume value growth available to the company. Does that answer your question, please?
That answers my question very well. That's perfectly what I asked. A couple of follow-up questions. These 8,500 outlets that you're targeting through a distribution type network, how many distributors have you appointed for this?
It's about 135 odd, basically.
And would these distributors be exclusive in nature? What would be would they do servicing as well?
So, they are not exclusive in nature, barring a few of them. Most of them are distributors who also deal with other brands. Typically, a good distributor, would be dealing with maybe 2 to 4 brands. That would be a sort of a thumb rule across India.
Right. So I guess we'd have to increase our share within the distributor sales as well.
That's right. We have to, one is of course to get the share at the counter level, which is the account level. Also as far as the distributor is concerned, because he is the one who has invested in stocks for IFB, one of the key jobs we also have is to show the distributor that his ROI on IFB is as good as or better than others. So there is a degree of work that we need to do also with the distributors.
Right. That makes sense. That makes sense. I guess it's a slow process. It will take its own time to show progress. I had a question in terms of the category evolution that you mentioned for ACs. It's a pretty very bold comment that you make that you could have sold 90,000, but you are at a volume of what you are. Beyond the effect of price, which is frankly beyond everyone's control, what do you think does IFB need to do in this category to what has not worked? When you say that you could have done 90,000, what is it that you estimated should have worked but did not work?
So that is a very good question, and I will try and answer this to you the way we see this. If you look at the air conditioner market, then it has a range of brands. So you would have an Onida or a Godrej operating at one end of the spectrum, and you would have someone like a Mitsubishi operating at the other end of the spectrum, and at the top you would have a brand like Ogeneral. In the middle, between these two, you would have LG, you would have Panasonic, Daikin, Hitachi, the Japanese brands, sitting towards the higher end, and everyone else a little lower than them. I think one of the key challenges that we have for the IFB AC is to really be able to convey where we stand. And one of the questions that Ankit asked previously, to which I should have actually added this point, is that we believe that the IFB brand can actually stand at the upper end of the spectrum. So I think what we have not been able to do to specifically answer the question that you asked is that we have not been able to position the IFB AC exactly the way we want. So in some parts of India, our people are competing against the Hitachi. In another part of India, the counter in which we are displayed, somebody might be actually comparing us to a Godrej AC. So what we would like to do as a part of this localization project that we are doing is to configure an air conditioner and present it in a manner that IFB and the brand that IFB is, the air conditioner matches up to that brand, that we position correctly, which is towards the upper end of the spectrum. And there is a set of customers who would be willing to accept basically the right product from IFB positioned correctly, and that is the volume that we would like to achieve.
Thank you. I would request Ms. Agarwal to come back in queue for follow-up question. The next question is from the line of Manoj Gori from Equirus Securities. Please go ahead.
Yeah, thanks for the opportunity again, sir. So just one thing. So at the end, at the start of FY19, we had given indication about hiring 800 new sales promoters, which would be generating efficiencies from the newly added distribution network over last 1.5 years. So any progress on that, and how many of those 800 have been hired, and what's the future outlook?
So as of end of January, we have added an incremental extra of around 350 numbers, and the remaining still needs to be done.
Okay. So secondly, if you look at the top-load washing machine, I think the highest selling SKU would be 6 kg variant.
In the market, yes. For IFB, it is a 6.5 kg. In the market, yes, the 6 and 6.2 kg are much more than the other categories.
So today, when we are trying to gain that market gain volumes from that category, which is the highest selling SKU, that would be 6 and 6.2 kg. So why are we only coming into 6.2 kg? Ideally, we should come with 6 and 6.2 both, if we want to target that entire segment.
So we went through the details of the segment in terms of the price points and the sort of margin profiles that we would command. And our choice was that we would not address the whole segment, but we'd address the 6.2 kg segment. So if 50-60% is, let's say, 6.2 category, then more than 60% of this is basically this category and the price point that we are targeting at 6.2 kg, and we'd like to play in that.
Okay. So, sir, can you just, if you can share, what was the key reason for not coming in with both the variants?
Both the variants mean 6 and 6.2.
Yeah.
So if you look at the 6 kg, then typically you will find price points of 13,000, 13,500 in the market. Whereas the 6.2 kgs are typically at around 15,000, 16,000 and above. So why we are not doing the 13, 14,000 price point is that we don't think it is a good margin profile in that price point, and hence we will stick to around this 14,500, 15,000 price point, which is the 6.2 kg.
So this 6.2 kg after launching, it won't be there won't be any incremental pressure on our profitability.
No.
It would be a normal profitable business for us.
Correct. Which is why we chose this price point, and the model that we've configured takes care of the margin profile also.
So if sorry if I missed out, when are we planning to launch this 6.2?
It will be early quarter one.
Early quarter one. So maybe by next season we would be ready. So maybe in festive season we would be ready with the product.
Yes. We'll be fully ready, yes.
Okay, so that's all, sir. Thank you.
Thank you, ladies and gentlemen. Due to time constraints, that was the last question. I now hand the conference over to Mr. Chirag Muchala for closing comments.
Yeah, thanks. I would like to thank the management for giving us the opportunity to host the call, and to all the participants for your presence. Sir, would you like to make any closing comments?
Thank you all for joining the call.
Thank you.
Thank you, everyone.